Hey guys, let's talk about how this is a big week for money markets. By the time this video is uploaded, we'll already know some of the short-term results and effects of the Federal Reserve Economic Symposium at Jackson Hole, which is starting today. And on top of that, if you zoom out, consider the fact that we've been entering into an increasingly challenging macroeconomic backdrop. For one, we still have the ongoing Ukraine-Russian war. There's also the significant economic slowdown across Europe. I'm also starting to hear about China's debt bubble, which, if played out to scale, is a big deal considering that it's the second largest economy in the world. But on the positive side, the long-awaited Ethereum merge does look like it's going to be happening in just a few weeks on September 15th. And you also have big institutional players like BlackRock and MicroStrategy pouring billions and billions of dollars into the crypto market. So a lot of fun stuff to cover. Let's break it down. Hey guys, welcome back to Not Financial Advice. So in a sign of how close digital and traditional markets have become, crypto traders can no longer live without knowing what's happening on stock exchanges. In recent months, the price of cryptocurrencies moved in sync with US stocks, making the correlation between digital assets and two key indices, the S&P 500 and NASDAQ, the strongest since 2010. Now, after July's Ethereum merge rally, we saw crypto's market cap recover from the lows of June's sell-off and retake that $1 trillion mark. But things got a little rocky again last week. And since then, the market has shed about 1.2 billion, dipping below that psychologically significant $1 trillion mark at least 3 times. And so let's take a look at what could be contributing to this downward pressure. For one, a lot of investors have been pricing in a 0.5 interest rate hike, but recently several Federal Reserve officials have kind of spooked the markets with the possibility of a 0.75% rate hike instead, suggesting that inflation might not have peaked yet. Mary Daly, president of the Federal Reserve Bank of San Francisco, also commented during a recent interview that she was open to backing a 75 basis point increase. So investors are hanging on to every word that the Fed is saying. And Joe DePascal, CEO of cryptocurrency hedge fund manager BitBull Capital, he said the sharp decline today is a result of market participants reducing risk after renewed expectations of Fed's hawkish treatment. Remember, their goal is to try and bring down this inflation to 2%, because usually the average inflation year over year is 2 to 3%. What we've seen is over 8%. So we have a ways to go. So you may not have remembered, but last year, China had a huge problem with the Evergrande debt crisis. And ever since then, there hasn't been a lot of headlines surrounding this. But most recently, I've seen a lot of news come out that maybe this debt crisis is bigger than we actually think it is. And that's not a good thing considering China is the world's second largest economy. They're undergoing a current financial crisis sparked by the Evergrande group defaults and the difficulties of other Chinese property developers, because you have these new Chinese regulations that strain these companies' debt limits. And so they're taking on really enormous amounts of debt. Not only that, but China's zero COVID policy has really taken a toll on its manufacturing businesses. Combine that with the most recent unprecedented heat wave in Sichuan, it's causing a lot of downward pressure on manufacturing and economic growth. If this lasts for longer than, 2 or 3 weeks, we could see some serious supply shortages that could be worse than COVID. Because the thing is, when you have a COVID zero policy, you can kind of rotate different people in and out of shifts at the factories. When you have a heat wave that is causing these factory shutdowns, there's no rotating in and out. The factory is just shut down. It's too hot. You can't operate it. And so when that happens for too long, you're gonna have massive supply shortages. And we saw a little bit of what that looks like on the global scale during COVID. So imagine that, but potentially worse if this heat wave continues. Okay, so we have all that, and we have all these forecasts of Europe going into a recession within the next 12 months. Some predict globally things are looking a little gloomy, but there is always a silver lining. Major institutions pouring billions of dollars into crypto markets. BlackRock, MicroStrategy, and the institutional giants are making crypto winter moves. You know, in another sign of momentum, institutional investors have put in a total of $474 million back into the crypto market in July, which is almost a complete reversal of June's $484 million of outflows. BlackRock has partnered with Coinbase for institutional crypto trading. Plus, other major multinational firms are making moves amid the crypto downturn. Now, if you don't know, BlackRock pretty much owns everything. They oversee around $10 trillion and is the world's largest asset manager. And they decided to partner with Coinbase to help their very institutional clients trade and manage crypto. You also have Bank of America, the second largest one in the US, releasing a new report saying that blockchains have intrinsic value and rejecting recent claims to the contrary. So now you have banks and major institutional players flip-flopping, you know? Years ago it was crypto has zero intrinsic value, that crypto is the worst, it's the game of the greater fool theory, right? But now, slowly but surely, you have major banks, institutions coming around and finally admitting what we've known all along is that crypto and blockchain do have intrinsic value. The game that they've been playing is putting out negative news in the media so that retail stays away from it, price drops because demand drops because of the bad news, institutions come and sweep up the dip, and then all of a sudden all the good news comes out. Bitcoin is a legitimate asset, and now price skyrockets and these institutions take profit off of the retail that they had scared away earlier. European asset manager Brevan Howard raised $1 billion from institutional investors to launch one of the largest ever crypto hedge funds. You also have the VC firm Andreessen Horowitz holding the fundraising record with their $4.5 billion crypto fund. Meanwhile, you have a former crypto head at PwC raising $75 million for a new institutional crypto asset management firm in Dubai. So why this matters, right? Well, Wall Street's entrance into the crypto sphere was a key catalyst for the massive bull run that we saw last year. So what could the last month of institutional money flowing back into the market mean for the future? We also have pension funds now entering crypto. Fairfax County Retirement System in Virginia followed through on plans to invest $70 million in crypto lending markets, also known as yield farming. And right now we're just waiting to see what's going to happen with the fork. So the Ethereum merge in the next few weeks is going to be proof of work moving to proof of stake, meaning that the consensus mechanism is now shifting to a new system entirely. Before, the issuance of Ethereum was going to pay the miners who did the work of validating all of the transactions. So after the merge, all of the new Ethereum issuance will no longer go to the miners, who sometimes take profits immediately, putting downward pressure on the markets, on the Ethereum price. And now you're gonna have all of the issuance going to Ethereum stakers. But remember, the thing about staking is that you're locking up your Ethereum for an X amount of time. And what they've said so far is that you can only begin unstaking and basically selling after the Shanghai update happens. That's estimated to be 6 to 12 months after the merge is complete. I think there's going to be upwards pressure going up to the merge as people buy the rumor. But then when it comes to selling the news, depending on the balance of supply and demand, it's going to be harder to sell the news, considering that millions locked up in staking can't directly be sold. There are other ways, such as Lido and Coinbase's new platform for giving liquidity to your staked ETH, but we have yet to see how this is truly going to play out. Also keep in mind that on the technical level, we're still trading below the 200 EMA, which in the previous cycles has been part of the bear market. And the bull market does not start until we are well and clear above the 200 EMA. I don't think that this is a long enough bear market, honestly, considering all of the macroeconomic factors that we're in. So now you can see why this is gearing up to be a big week and few weeks of what happens next. So with this many factors at play, however the cookie crumbles, I will be sad but prepared if things continue to be bearish. But on the other hand, I will be surprised but happy if things suddenly do turn bullish. That's it for this video. Thanks for watching, and I will see you next week.